Good afternoon, everybody. Thank you so much for joining us on this very, very cold afternoon. We are very excited to have you today. We have a very special guest, and I'm not going to do a lot of the talking today. I know most of you. For those of you I don't know, my name is April Reed Cruz. My sister, Abby Reed, is co-hosting with me today, and we have the honor of having someone who I respect immensely, a good friend of ours, and one of undoubtedly the best and most respected Social Security experts in the nation, Heather Schreiber. As you know by now, there were some pretty sweeping changes that were just passed a couple of weeks ago with regards to Social Security benefits for millions of people, and this could really have a tremendous impact on financial plans for a lot of families. So we're going to talk about the Social Security Fairness Act today. Before we begin, we have to do our obligatory lovely disclaimers. It makes me feel a little bit like a pharmaceutical commercial, but we have to keep compliance happy. And we will have a question and answer session towards the end of the program today. You will just type in those answers on your screen. We'll walk you through how to do that when we get to that point. So if you have questions as we're going through the materials today, jot them down to make sure you don't forget, and make sure you get those questions in so that you can take advantage of this wonderful guest that we have today. But we're going to go ahead and begin the landmark changes that were made to Social Security, and Heather Schreiber will have her own lovely disclaimers as well. And then we will go ahead and get started. Heather, I don't want to take another minute away from you. Thank you so much for joining us today, and take it away. We're excited.
Thank you. Thank you to you both. I'm excited to be here. We don't need to talk about me, but I do have a passion for Social Security planning and retirement income in general with consumers. And this is a hot button, one that I was quite surprised that passed. But on January 5th, former President Biden signed into law what's called the Social Security Fairness Act of 2023. And you say 2023, it took that long? Yes, indeed it did. But it was signed into law on the 5th of January, retroactive to benefits payable after December of 2023. That is significant for some of you that may be listening today, but we're going to go through it, and this is what we've got planned for the next, 45 minutes or so until we get to questions. First, I'm going to tell you what it is in plain English. I try to put these technical things in as easiest terms as I can. We'll talk about the provisions that this act changed and repealed. Now, the act, believe it or not, is a whopping 1 page long, but I'm going to talk about that. We're going to talk about dollars and cents. We always perk up when we start talking about that. We're going to talk about how does this impact those that are actually directly impacted, how does it affect long-term planning, and perhaps those of us that aren't impacted by this legislative change. We'll talk about specifically, can I expect an income boost? Who are the ones that can expect an income boost? How and when will that happen? We'll talk about that. I'm going to give you a few case studies so you kind of understand, does this affect me? Hopefully these case studies will make you go, yeah, I remember that when I contacted Social Security. So yes, I can expect either a refund or to have this not affect me when I thought at some point in the future when I collected benefits it would affect me. And then we'll talk about planning implications beyond this act itself. So that's where we're going to go. So what happened? So this had large bipartisan support. And like I said, it was signed into law on January 5th. There hasn't been a whole lot of activity since January 5th to tell us exactly how this is going to go in terms of those that are expecting refunds. But it essentially repealed two long-standing provisions, one called the Windfall Elimination Provision and one called the Government Pension Offset, which I'll explain to you in a moment. But essentially, it impacts public sector employees who have worked and earned a pension or have taken a lump sum in lieu of that pension based upon earnings that were not subject to Social Security taxes. That's the demographic that is impacted by the specific law. So it doesn't affect, you if you've always paid Social Security taxes on your earnings, but if you've been in that kind of position for a federal, local, state, municipality where you didn't pay Social Security on your earnings and instead you were paying into an alternative but equivalent or better system than Social Security, this could affect you. So it will increase, as April said, millions of people. So it affects about 3 million current beneficiaries of the 68 million beneficiaries on Social Security. And those can include, like I said, public, governmental, former public or current employees, including some teachers in some states, some firefighters, police officers, and other federal, state, and local workers. And as I said, some are entitled to retroactive benefits because this went back retroactive to benefits payable as of at the end of December 2023. So anything paid in 2024 and on. So if you're an ongoing recipient of Social Security and you've been impacted by one of these provisions, then Social Security will be giving you a refund, probably in lump sum, I suspect, that will give you the difference between what you should have been paid had these provisions not been in effect versus what you've collected. So that's where we are. So let's talk a little bit about what these provisions are. The first one is the government pension offset. And believe it or not, this has been around for, if I do my math right, about 48 years. It came into being in 1977. And it essentially is a provision that says, hey, if you don't pay into Social Security and you're entitled to a benefit as a spouse, ex-spouse, or survivor of someone else, which that's how it works with Social Security, right? If you've never paid into Social Security, forget the public sector work for a second. If you've never paid in, that doesn't mean you won't get a benefit from Social Security, right? If you've been married to someone who is a worker that has earned eligibility, if you were married to someone and divorced after 10 years, or if you're a widow, all of those benefits are still available to you, even if you never work. So that's what the government pension offset was established to do. It basically said, if you have a non-covered pension, and when I say non-covered, I mean a pension based on work that wasn't subject to Social Security taxes. If you have that, we want you to either get that pension or the spousal or survivor benefit, but not both, right? It's kind of the way Social Security works. Well, originally it was a dollar for dollar reduction, just like Social Security would work, but later it was switched to 2/3 of the non-covered pension. So what you might see, and I'll show you an example in a second, is if you had a healthy non-covered pension, like you were a teacher in Gwinnett, for example, and we know that the Gwinnett County teachers don't pay into Social Security. If that person had a $3,000 pension, then and they also were married to someone, and they said, well, wait a minute, I should be able to get a spousal benefit. Well, the government pension offset said, not so fast. We have to reduce your spousal benefit by 2/3 of that non-covered pension. And that oftentimes would either wipe out a spousal benefit or sharply reduce it. And so that's the government pension offset. So giving you an example where Emily, she's a longtime Gwinnett teacher. She's collecting $3,000 monthly. She's also entitled to a $1,500 a month spousal benefit. She's never worked in Social Security, but she's entitled to that spousal benefit. Her husband, James, has a $3,000, what's called primary insurance amount, his benefit at full retirement age. So as a spouse, under normal circumstances, since she doesn't have entitlement on her own, she's entitled to as much as 50% of that $3,000 or $1,500. But in the past, once she started collecting her TRS pension, Social Security would say, wait a minute, we're going to reduce your spousal benefit under Social Security by 2/3 of that pension. Well, in this case, 2/3 of 3,000 is 2,000. It would simply wipe out the spousal benefit. So if you're one of those people that has happened to, or you thought it would going forward, that is what's going away. So in Emily's case, if she was collecting benefits in 2024 and she was denied Social Security benefits under James's record, well, now she's entitled to that $1,500 a month for all of those months going forward. Okay, so it's pretty significant. Now, the other provision is called the Windfall Elimination Provision. So government pension offset, remember, is for someone who never worked under Social Security. So their earnings came from that non-covered pension system where they paid into an alternate system, right? Windfall Elimination Provision is for individuals who have worked both in the public sector where their earnings weren't subject to Social Security, but they were contributing to a system like a pension like Social Security. And they also worked enough in Social Security covered employment that they earned eligibility to Social Security retirement benefits. That's where the windfall elimination provision comes in. And basically that would basically say, because your benefit under Social Security is calculated as if, well, it's calculated based on your highest 35 years of earnings. And because when we look at we being Social Security, when we look at your earnings, your non-covered or your non-Social Security tax earnings, if you've ever looked at your Social Security statement, will show a 0. But when the calculation of your benefit is done, that puts you falsely into a low wage earning situation. And you're really not, because your earnings are over here on this other system. So the windfall elimination provision was designed to sort of equalize the playing field. The good news about the WEP is that it would never, if you've earned, so you've had a hybrid career and you've earned eligibility in the Social Security retirement benefit, WEP would never reduce your benefit to 0 on Social Security, never would reduce it to 0. It might reduce it, but it would never reduce it to nothing, like the government pension offset. So the reduction there is the lesser of 50% of your non-covered pension or a maximum dollar amount. So like in 2024, for someone who's turning 62, that amount would be $587. So that's the two provisions. They've both been completely wiped clean. As of January of 2024, they no longer apply. So what's the dollars and cents? Okay, who does this impact? Well, of all 69 million beneficiaries, it only impacts roughly 4% of all Social Security. And I'll mention, I haven't said it yet, but railroad retirement. So if you've ever worked or you're married to someone who has railroad retirement benefits and also has worked under covered employment, those individuals could be affected too. It's about 4% of overall Social Security recipients. 2.1 beneficiaries will receive refunds due to the WEP. So that's the one where you've had work that was covered under Social Security, it was taxable, and work and a job where you earned a pension where it wasn't covered or isn't covered currently. So the average, according to the Congressional Business Office that did a whole study on what the impact was going to be, they're estimating that the average monthly increase by December of 2025, once they get it all worked out and everybody's getting their benefits adjusted up so that the WEP doesn't apply anymore, will be about $360 per recipient. So that's pretty significant monthly. Another roughly 749,000 beneficiaries are affected by government pension offset and are due refunds. Now, this is where you're going to see a much steeper increase in income. And according to that, for those that are receiving or were denied benefits as a spouse or ex-spouse because of that 2/3 of reduction from their pension, they're looking to get on average about a $700 increase versus widow or widowers who might get as much as an $1,190 increase on average. Now, it could certainly be more than that. And I suspect, I've worked cases where it's much more than that. So these are the folks that will get a refund. Again, lump sums coming. We just haven't heard how that's going to be implemented yet. I will tell you that if you or know someone, if you have worked for railroad retirement, married to someone, it's only tier 1 of the Railroad Retirement Board pension that is affected by WEP or GPO. If there was a non-covered pension in play here, it's not the tier 2 part, but there still could be some effect there. So if that is you, Railroad Retirement Board is also they have on their website, they also are keeping people up to speed on the status. And basically they've said, give us a minute, probably give us like several months to figure out how we're going to implement these changes, how we're going to get refunds back, because this is a big change and it's going to require changes in calculation methods and behind the scenes calculations inside the system. So here's the other thing that people often ask me. So is the reduction on my pension side too, or is it just on Social Security? Keep in mind that what we're talking about here is only reductions that have occurred or could occur in the future as a result of the WEP and GPO. It's only on the Social Security side. So this doesn't affect your pension at all. The pension is the pension paying system. We're talking about repealing of the two conditions that would reduce or possibly eliminate any benefits that you may have been entitled to in the past or would coming forward once you collect a pension from a non-covered system. So here's what it comes down to. Can you expect an income boost? You can if you are a public sector employee or retiree who is entitled now, so you're collecting, or you will at some point in the future be entitled to collect a pension based on an employer who doesn't withhold Social Security taxes from those earnings. Again, that's called non-covered earnings. And the way you can tell is if you look at your Social Security statement, in the Social Security column, it will have zeros in the Social Security taxable column, and usually it will have your earnings in the Medicare column, because usually you still pay in for Medicare. Okay, some don't, very few, but most of the time you'll see your earnings in the Medicare column. That's the way to tell. So you've got that non-covered pension now or in the future, and you're eligible for either your own Social Security retirement benefit or railroad retirement benefit, because you've earned the right to that by covered work, by Social Security tax work. Or you say, no, I didn't work enough, but I'm married to this person, or I was married to this person and divorced after 10 years, or my late spouse or ex-spouse passed away and I'm entitled to a widow or widower's benefit. Those are the folks that will be affected directly by this act. Now, examples are federal government. So the federal government, really, the only ones that will be impacted are the former civil service retirement system and some civil service retirement system offset pension annuitants. So the ones that were hired before 1984. Now, those folks didn't pay into Social Security, so they could see an increase definitely in their benefits that they are entitled to receive under Social Security. They were then replaced by the federal employee retirement system, the FERS system that does pay in. So FERS annuitants are not impacted by this at all. Don't expect increases because their earnings are subject to Social Security taxes. Other examples are state and local teachers. Now, we have a hybrid of teachers across the state. It depends on which state you're in. Georgia, I call it a confused state. It's a bi-county state, so it depends on which county for which you work to determine whether or not you pay in. So in my county, I'm in Cherokee County, I know that they pay in, but I know that in Gwinnett County, they don't pay in to Social Security on their earnings, nor do they in Fulton. So you have to look at the county for which you worked, and sometimes that will give you a hybrid situation where you worked in Cherokee, where you paid in for several years, and then you moved over to Gwinnett, didn't pay in. Now you're a hybrid employee, right? Because you've had some covered earnings and some non-covered, and that might put you in a WEP situation, right? You could have community college and K through 12 district employees, university employees in some states, like I said earlier, firefighters, police officers covered under independent retirement systems, employees of certain state agencies and municipalities who opted out of Social Security. It's called Section 218. They could opt out. And as long as they had a system that it was equivalent or better than Social Security for their employees, then they could continue on that. And then there are certain employees who have foreign pensions that could be affected, not by government pension offset, because that never applied to foreign pensioners, but like a Canadian pension. For someone who has access to a Canadian pension and they've also worked in the United States, there are cases where they've been affected by Windfall Elimination Provision, and they will also be due refunds or won't have to worry about it going forward. So here's the situation that could boost your benefit. So start thinking about if this applies to you. Again, you had a hybrid career. What does that mean? Remember, you've paid into a system or you've worked for a public sector employer that you did your earnings were not subject to Social Security taxes, and then you worked for an employer that does, or yourself, where you're paying FICA taxes. Okay, that's a hybrid situation, and that's where WEP would be in play there. Or you received a non-covered pension. You don't qualify for Social Security benefits because you spent your career over in this other non-covered pension, like you've been in Gwinnett County Schools your entire career. That would be a situation where GPO might affect you because you have entitlement under someone else's record, your spouse, your ex-spouse. That could be a situation where now you're entitled to either a higher spousal or widower's benefit, or one at all because you were before told that you weren't eligible for it at all. You are a non-covered, meaning you haven't paid in, who was denied spousal benefits under GPO. So you previously claimed, or you tried to with Social Security, and they said, sorry, because of your non-covered pension, that two-thirds thing, that wipes you out. So you've denied, you're not collecting anything. You would be entitled now to go back and say, wait a minute, hello, remember me? I'm now entitled to those benefits because GPO is no longer. So this could apply to you whether your spouse is still living or if your spouse has passed away. And here's what I call the innocent bystander effect. You are the dependent spouse So the dependent spouse means you've never gotten your own Social Security, you've never worked enough outside the home to earn Social Security eligibility, but you've also never been in a non-covered system. So you're just a dependent spouse who should be able to claim a spousal benefit under your Social Security eligible employee. So you've got a hybrid spouse, right? So they've worked inside Social Security long enough to gain eligibility. They also have a non-covered pension. Well, the innocent bystander effect is that the dependent spouse is only entitled to 50% of the WEP adjusted benefit. They get kind of affected just because of the non-covered pension person. They really shouldn't, but they do. So that is kind of one that you might not think about that would affect you. So you might see an increase in your benefit too. Here's another thing that I will say, because I keep mentioning pension. If you were one of the folks that said, you know what, instead of taking the pension that my employer offered, I took a lump sum instead. Now, that should have, lump sum in most cases in lieu of the pension doesn't get you out of being subject to the WEP or GPO in the past. People thought, oh, I'll just take the lump sum and I'll get out of that. It doesn't usually. There has to be certain circumstances for it to not count as a pension for WEP and GPO purposes. So if you're a person that took the lump sum and you're not collecting a pension, but you at some point filed for Social Security benefits under your own record or somebody else's, and you were denied or reduced, you would also be due an increase. Or you haven't yet filed for anything, you plan on taking the lump sum from your non-covered pension, you would also not have to worry about WEP and GPO anymore on that Social Security benefit. The $1 million question is, when can I expect my refund of underpaid benefits? Well, it's probably going to be a while. Railroad Retirement's website has been a lot more forthcoming to say, hold the pony, because it's going to take us a minute to figure out how to implement these refunds, how to implement the changes in the procedures, and how we go forward with reprogramming our systems to not include WEP and GPO reductions. So I suspect, I don't have a crystal ball, but I tell you that I look every single day in the Social Security. If you go to ssa.gov or RRB, you will see that they have a page that is consumer friendly that says right on their homepage, look here for updates to the Social Security Fairness Act. On Social Security's website, that thing hasn't been updated since the day after this act went into force. And it's basically sitting there to tell you the most recent information about it. I suspect it's going to take a while for refunds to be issued. But what I will tell you is I have heard that they've been working really hard on their 1-800 number, getting hold times down to about 20 minutes. And last week, somebody reported during a session of Congress that it was up to 1 hour and 28 minutes. I suspect it's because all of these people that are affected are calling and saying, when can I get my refund? Don't do that. Save yourself the headache and the hassle, because what Social Security has said, as well as RRB, is that if you are due a refund, you have already filed, and sometime in the past, either your benefits were reduced because of WEP or GPO, or they were denied completely, they already know you filed. There is no reason for you to call again. There's no reason for you to claim again at all. Don't do anything right now, because they already have record that you tried to file and you were denied or your benefits were reduced. So save yourself a headache. Now, if you're going forward and you're saying, well, but I want to file and this provision would have normally affected me, can I file? Also on Social Security's consumer page, you can check it out. It does say, yes, you can file. The easiest way to do that is online. You might still have to answer questions like in the past when it did apply. They asked a whole host of questions about non-covered pensions that you might receive. They may still have that on the online application. I haven't heard of anyone yet that has filed in the last 2 weeks to tell me. You may still have to answer those questions, but you can go ahead and file. The easiest way is to do it online. And they will, they say that you can file and they won't reduce your benefits. It might take a little bit longer to get those benefits started, though. So that's that. Let's see, who isn't affected? Let's start with that. That's the easier list. Those whose only pension is for railroad retirement. If that's the only thing you have, there's a quirky rule between Social Security benefits and railroad retirement, but it's not WEP and GPO. So if your only other pension is railroad retirement, WEP and GPO doesn't affect you. Like I said, if you are a federal employee retirement system annuitant or will be employee or the spouse of, this doesn't affect you because your earnings have always been subject to Social Security taxes. So you've never gotten a reduction. If you're not sure, again, go look at your earnings statement under Social Security. There's two different, you've got, when you log into your Social Security account, there's a 2-pager, your Social Security benefit statement, that gives you sort of a truncated view of all of your earnings. And then you can actually go look at all of your earnings year by year for as long as you've worked. That's where I would go and look at every single year, and where you see zeros in the Social Security column in years that you know you worked, that is a non-covered year, okay? And if you have 30 or more years of substantial Social Security earnings, so say you worked in Cherokee County as a teacher for most of your life, you were paying into Social Security, and then you were over at Gwinnett for a little bit of time. If you have 30 years of what Social Security calls substantial earnings, they define it differently every year. I think this year it's roughly $31,000. And if you get up to 30 of those, then you wouldn't have had to worry about it anyway. And so if you're collecting benefits and you're not, your benefit wasn't reduced by Windfall Elimination Provision, you're one that doesn't have to worry about it either. So, April, do you have anything you want to say, or should I just keep going?
You are absolutely slaying it, Heather. Keep going.
Okay.
Yeah, I agree.
I'll interject and say that if you do have a question along the way, you can submit it. You don't have to wait until the end. You'll see a little questions and answers tab. I can tell some of you have found that already down at the bottom. But as we go through this, if you have a question, you can go ahead and enter that, and we'll spend some time with questions at the end. But you're doing great, Heather. Thank you.
Okay, good. So I like examples because it helps me, solidify things in my mind. So let's look at an example of Jill. She was a hybrid worker. So she was one of those that worked partly in her career as a covered employee where she paid Social Security taxes on her earnings, partly out. So in her, she's a retired Georgia school teacher. Okay, so she worked, I keep saying Gwinnett because it applies to us, right? We're in Georgia. So she worked in Gwinnett County for 25 years and the other in Cherokee for 18. So she has this hybrid situation. So we know that she's earned her pension in Gwinnett, she's earned her pension for Georgia retirement system. But she's also worked enough in covered employment. She has to have on average 10 years of work to earn Social Security benefits. So she's worked 18. We know she's earned a future retirement benefit under Social Security. Her combined pension, don't hold me with numbers because I'm not a teacher, so I don't know what their pensions are, but I'm going to say that her combined pension is $3,500. We need to know what portion of that in the past, we would have needed to know how much of that pension is based upon her Gwinnett, her time of a non-covered. We know that is $2,800 of it, because that would have come into play if we were calculating the government pension offset, that 2/3 reduction. But now we don't have to care about it. But let's say we know that $2,800 of Jill's pension was based upon her non-covered work. Jill's Social Security benefit is $1,100. So that's the amount that she should be entitled to based on her 18 years of work, had we not even been concerned about her Gwinnett pension. But her WEP adjusted benefit is $700. That's what she's been collecting, okay? Because she's been collecting that reduced benefit, and she lacks the 30 years, so we know she's only got 18. She doesn't have 30 years of covered earnings. We know that she's affected by this. So now she's due a refund. Let's assume she's been collecting long before January of 2024. She's now due only up from January 2024 forward of that additional $400 a month. That she didn't get from January until when Social Security gets this all figured out and they start paying her the $1,100. So she'll get the difference in probably a lump sum payment to be determined when that occurs. Okay, so that's a hybrid. So let's look at another case of Steve and Mary. So Mary is a longtime non-covered teacher. She's not eligible for Social Security under her own record because she worked her whole career, let's say, in Fulton. Okay, well, that's what I say here. She's 72. Her monthly TRS pension is $4,000. Under normal circumstances and how it will be going forward, she's entitled to a spousal benefit. She hasn't earned her own benefit, but now that GPO is gone, she's entitled to half of her husband Steve's $3,500, half of his benefit at full retirement age, assuming she collects it at full retirement age, which we now know she's 72. So of course she would be over that. Because of the GPO, that 2/3 reduction, though, she was denied the ability to ever collect half of Steve's benefit at full retirement age, because 2/3 of her $4,000 pension wiped it out. Okay. So now she's entitled to $1,750. So that's half of the $3,500, right? She's entitled to that back to January of 2024 going forward. The other thing is, if Steve predeceases her, now, just like any other Social Security survivor, she will be entitled to step up. So if Steve is collecting, let's say, I don't know, $3,800, whatever, $4,000 at the time he passes, she's going to be able to step up to that as his survivor. There's going to be no GPO 2/3 reduction anymore. She'll get that and her $4,000 a month pension. So you can see how this can be a significant increase in income for people that are in this kind of situation, like this example with Mary. Okay, let's look at an example where I was talking about the innocent bystander spouse effect. So here we're talking about, I know in Michigan, police officers don't pay in. So John, who's 68, spent most of his career as a police officer before retiring at 50. He collects a non-covered pension of $3,500 a month, but he also worked as a security guard where he paid into Social Security, and he now collects a WEP adjusted benefit of $900. So without the WEP, he would have collected $1,400 a month, but because of the WEP being in play, his benefit was reduced by $500. So he was only entitled to collect $900. Well, because of that, his spouse, even though she was the innocent bystander, Susan, she started collecting dependent spousal benefits while WEP was in force, right? So instead of getting 50% of his $1,400 benefit, she was only entitled to 50% of his WEP adjusted benefit, or 50% of $900. So she was only getting $450, when had WEP not been applicable, she would have gotten $700. So I call that the innocent bystander spouse, because she didn't do anything. She just was kind of had a bystander effect of his WEP adjusted pension. So now they're both going to receive refunds, right? He's going to receive $500 more a month going back to January 2024, and she's going to receive an increase too of that spousal benefit that she should have been receiving based upon his higher non-WEP adjusted benefit or primary insurance amount. So all kinds of ways that you can see that people will be positively impacted in the their income planning going forward. Let's look at a CSRS retiree or annuitant. John, 75, paid into CSRS. So that was before 1984, where none of them paid into these federal employees. Civilian employees didn't pay into Social Security. He has a very steep, hefty pension of $6,000, which is nice. Betty is 71. She recently claimed Social Security benefits, so that's his wife. She has a primary insurance amount of $3,000. That's the amount that she would collect if she collected it at full retirement age. Her current monthly benefit, though, is $4,059. Okay, so she collected late. She collected at 70. Before the Social Security Fairness Act passed, government pension offset would have completely reduced or wiped out John's ability to collect $1,500 under Betty's record, right? Because the 2/3 of his $6,000 would have wiped it out. That's $4,000. That's far more than the $1,500 that he was afforded. Now that it's gone, guess what happens? Well, now he's entitled, if he had filed and been rejected, which he may not have even filed. I mean, I don't know. She just turns, in my example, she turned 70 and filed. If he had already filed at 70 and was denied, then he doesn't need to do anything. He'll just wait to get his refund like everybody else. If he hasn't yet filed, then he can go back and request, when he claims, he can go back and request benefits to when she filed. Okay. So without, I think I've already said this, but we'll go over it again. Without government pension offset, he's entitled to $1,500 monthly back to January 2024, or when Betty filed again. That's if she filed, in June of 2024, that's as far as he could go back. The other thing is, if Betty dies before John, now he's entitled to her survivor benefit of $4,059 plus his $6,000 pension. I mean, that's $10,000 a month of pension annuity, income. So that's great. And now John's monthly pension, will increase from $6,000 to an additional $1,500 while both he and Betty are living. And if she dies again, he'll increase to just over $10,000 a month to collect her survivor benefit. If he dies before Betty, she will continue to collect her $4,059 because it's obviously bigger than any benefit he doesn't have a benefit under Social Security other than through her, and whatever survivor benefit that they've chosen under the CSRS pension. So there you go. Okay, so we've gone through all the examples. Now we need to talk about, so what does this mean, right? So it seems that all this money that's outflowing, what does it mean for the problem that we have with the insolvency issue that we've been talking about for a whopping 13 years now? So the Congressional Business Office has estimated that about $196 to $198 billion will pay out of unfunded liabilities, meaning that we didn't plan for this, out of the Social Security trust funds to pay both refunded or annuitants or Social Security beneficiaries back from January 2024 through 2034. So over the next 10 years, between the refunds that have to be paid out and all of those that will now be entitled to benefits that weren't before, there's going to be about $198 billion paid out. So clearly that could affect, and likely will affect, the insolvency. So we were supposed to have full promised benefits according to the latest Social Security and Medicare trustees report, payable through 2034. Now we're looking at that this change will likely hasten that by about 6 months to mid 2033, and then there'd be enough to pay about 80% of benefits through ongoing revenue. So we're going in the opposite direction. Is it a huge change? No, but it still is nevertheless something that needs to be considered as these lawmakers decide what they're going to do, and are they going to continue to kick the can down the road, which is what they've done for the last 13 years as we've been talking about this. I will tell you, I've said this before this act was passed. We've been this close to insolvency before, back in late 70s to early 80s, and that's what caused the Social Security Acts of amendments of 1983. That's what changed the civilian federal employees from civil service retirement system. That's when they started paying in, and the federal employee retirement system, the FERS system, replaced it. That was one of the moves to a boost in solvency. The other was to increase over time the full retirement age from 65 to 67. That was also the first time that Social Security taxation was added in above 50% of a certain threshold. It was 93 when the 85% possibility of taxing 85% of benefits was added. So we've been here before. They've done things to raise revenue. They're obviously going to have to offset this in some way. How is that going to be done? I don't know. It could be, increasing full retirement age again. But the arguments there are, well, you have some workers that are blue collar workers that have manual jobs. It's difficult for them to continue to work. So that might not be the best solution. You have increasing the amount of income that earnings that are subject to Social Security taxes. Right now there's a ceiling. This year it's $176,100, and then you no longer pay Social Security FICA taxes of 6.2% on anything above it, but you continue to pay it for the Medicare portion. Could they remove that? Could they have a donut hole period where you don't pay it and then higher earners pay it again? That's one way. You can increase the 6.2 percentage to some other percentage for a period of time. There's all different ways to address it, but it all kind of comes down to, without having to reduce benefits to seniors, which probably I would hope wouldn't happen. It all comes down to mostly falling on the shoulders of the current workers, making them wait longer to retire, making them pay, higher FICA taxes or on more of their income, something like that. About the refunds, again, be patient with that. If that is something that affects you, I would not call. I would keep track. If you go to SSA.gov or RRB.gov, you can see they have, a page dedicated to updates. It might be a while before we get an update on how and when these refunds will be given. My question is, okay, so you're looking at some of these people in these examples I used, people are going to get $1,500 a month or $2,000 a month because of the government pension offset, or even more if it's a survivor benefit. We're looking at some pretty hefty lump sum refunds, which also is going to have an implication with taxes, because as much as 85% of Social Security can be taxable on the federal level right now, unless something changes, right? So that could have a ripple effect in other areas that could cause, obviously, to pay higher, put you into a higher tax bracket. If you're on Medicare, it could possibly push you into, having to pay not the standard premium, but maybe a higher a premium plus the premium surcharge if you get above a certain threshold, or maybe you're already there and it puts you into a different threshold. So there's other implications. I'm curious to know that with this refund and this act, is there going to be any relief granted? Like, can you include the income if you get it in 2025? Can you include a portion of the income in 2025 and some in 2026 to mitigate some of these, what I call stealth taxes, that might be the ripple effect of getting a lump sum? So that's what I'm curious about. I'm going to continue to watch, like with an eagle's eye about these changes. And so I think that that's it. If there's any questions that anyone has.
Thank you so much, Heather. There are some questions. I'm trying to weed through these. They were coming in as you were speaking. So if they are questions that you've addressed, I'll try to weed those out. Here is one. It says, you said that we don't need to file anything if we quote unquote already filed. Does that mean that if we're already receiving Social Security, we already filed? So if you could elaborate a bit more on that, please.
Good question. And I'm glad that's a great question. So yes, if you're already receiving, if you filed, if you made a claim for benefits and you're either collecting benefits, or say you claimed, you filed benefits, but then you were denied. So denial would only come to individuals who had a non-covered pension, who didn't have benefits that they had earned under Social Security. They weren't a hybrid worker, but say you were, a civil service annuitant who you've worked your entire career under civil service, didn't pay in, you tried to claim, you made an application for benefits under Social Security to file for spousal benefits, for example, or survivor benefits, and you were denied, meaning government pension offset reduced your benefits to zero. So there's two cases where, meaning if you've already filed, you could either be collecting benefits and that, hey, I was affected by this. I know that they reduced my benefits. I don't really understand the ins and outs that you just explained, but I know that happened to me. So you're receiving benefits, but they're reduced. The other is if you've never been entitled to Social Security, but you filed an application for benefits hoping to get an auxiliary benefit under your ex-spouse's record, whether it's for spousal benefits while they're living, or widower benefits. That's another time. So you're not collecting, but you made that claim and were denied. Those are the folks I'm talking about, that if you've already filed for benefits, you don't have to file again. They know that you exist because your name is already in the system, put it that way. You were denied. Now I would give it time. Now, the ones that aren't receiving anything, if you don't hear anything, once we start to get updates of how they're rolling out these refunds, then that's a different story. But from what I'm understanding and researching behind the scenes, they're saying, please don't make another claim. Just sit tight. We've already got your information. You've already filed an application for benefits. We have your denial or your reduction in the system. We will get to you. But if you've never filed for Social Security, you weren't ready to, or whatever the case may be, and you're like, okay, well, before I know that this would have affected me and I was kind of waiting to file, and you're ready to file. Don't go rushing down right now if it doesn't work for your overall retirement plan, but you can file now, and you will not be subject to the WEP and GPO. They're just saying, they being Social Security and Railroad Retirement Board, it may take a little bit longer to process your application, because they're still going through how to implement the changes on the inside in terms of how they, their systems, if you will.
So Heather, if it's been quite some time and somebody is not 100% certain if they did file and get declined or not, is there a simple way to check, or is that a dreaded phone call to Social Security to determine that?
It probably is a dreaded phone call. I don't know. I would start with logging into your Social Security account. If you've made a claim for benefits, it should already say that. But if you made a claim and they just denied you, I don't know if it would allow you to claim again. So the easiest way to know is if you go into your online Social Security account. If you've already filed an application for benefits, it shouldn't allow you to file again. So, but if it does allow you to file, then I would do it. right? But it shouldn't allow you to once you've already made a claim for benefits.
Thank you, Heather. Some of these questions are in regards to taxation. I think that you've addressed that pretty well here, just to make sure there's not anything else you want to add into it. I mean, you touched on IRMA. We're really not sure at this point if there might be an exception for the lump sum and any trickle down effect that it could have tax wise. That's I'm understanding, and please, feel free to jump in if you have anything else to say on that. But really, to be determined how that's going to be handled, and if there will be any choices for spreading it out in any way, if there will be, any exceptions made to that type of potentially unintended consequences of these repeals.
Right.
Anything that you would add to that, Heather?
No, other than that, that's going to have to be an agreement between Social Security and IRS, because the IRS is going to dictate whether or not there's some, reprieve there. But the first thing that popped through my head, I thought, well, here we have retirees who are used to a certain amount of income and have planned accordingly, probably with their tax planning. And, some that might be taking required minimum distributions now, and all of a sudden they get this huge boon of income, and they're like, wait a minute, this kind of messes up my planning, and it could have other effects. I really don't know. Whether there is going to be any type of reprieve or not, or they're just going to say, well, it's good for you that you just got this huge increase in income. It is what it is. I really don't know, but I'm very curious to find out.
Yeah, I am too.
Yeah.
Do you know if Social Security or any other entity will notify people that they are eligible now, or will people have to determine that entirely on their own?
Good question. I think that they'll probably notify them. It's kind of like back in March of 2024 when we had the repeal, or not the repeal, but the change in the way overpayments were handled. So people that were subject to overpayments because they, got too much because of WEF and GPO, which that'll be a whole nother interesting thing. So, if you've ever received a letter that you received too much in Social Security benefits, and you shouldn't have because they didn't factor into your benefits WEP or GPO, you're also going to get a refund, at least for the amount of benefits offsetting from January 2024 and on. They're going to wipe that overpayment off your record. That's another one I didn't even mention. I don't even know what you asked me because I just got off that track. Oh, they're going to notify you. So with overpayments, right, they didn't preemptively notify you before changing your overpayment percentage, because what they did is, before the overpayment change, they would send out a letter. For example, they'd say, well, we didn't know you had this non-covered pension. We've been paying you $1,000 a month in spousal benefits. Had we known, because of government pension offset, we shouldn't have paid you that the last 18 months. Please send us a check, cash charge, American Express, whatever, for $18,000. And if you don't pay it, we're going to start withholding your benefits until we recover it. Well, they changed that to a kinder, gentler version of SSA and said, we're not going to do it that harshly because we realize that this is income that people rely on. So instead, we're only going to withhold 10%. They didn't send a preemptive letter. They basically started just changing people to the 10%. So it wasn't like you got a letter first and then got your refund. They could surprise me, but I doubt it. I think that they'll send it all at the same time. But don't quote me. Crazy things could happen.
Another question that just came in a moment ago. So does all this mean that unless you are or were a government employee, you receive no income boost? Is there anyone that we're missing in there, Heather, that
no? So again, that's what you're looking for. If you are an employee who at some point worked for a state, local, federal, if you were civil service retirement system back in the day, municipality, where your earnings were not subject, or a foreign pension that you receive in some cases, where you didn't pay Social Security taxes, and until you work there long enough to become entitled to a pension, which is the equivalent of a Social Security monthly income benefit, those are the ones that are impacted. If you just worked for corporate America your whole life, or worked for, federal employee retirement system, FERS, or, a teacher in a state where this has no effect, which is most of them, then you don't have to, there's no income boost, unfortunately.
I think, Heather, the foreign pension aspect is one that you were the first person that I heard mention that. I don't think that's something that's necessarily widespread information. So that's a good bit there too, to make sure that those folks are not left out. And I
Yeah,
believe that this is going to be the last question. I'll turn it over to Abby afterwards for some closing remarks. Just to clarify, the refund and benefit amount will only be impacted by benefits paid from January 2024 forward,
that's
not
correct.
considering benefits paid prior that were reduced by web.
That's right. That's right.
Okay, perfect.
I was surprised it got a
If
retroactive effective date. So,
right, yep,
yeah.
that's the
That was the first
2023. But
that was the first question that I got from a client. We've just been talking to our clients about this, bringing it to their attention because I don't feel like this has gotten, I guess, as much attention as I thought it was going to get. I, for one, was very surprised that this was passed. I know it's been tried in the past and it hasn't gotten over that threshold, so it was kind of interesting. So this is fantastic information that you got together very quickly after this passed. I feel like we all just got a master's, a little tiny master's in Social Security, especially with WEP and GPO, which I think has really always been the most confusing aspect for the people that it affects of Social Security. And it really a lot of times people maybe assume that they weren't going to get a benefit, and now it's hopefully simplified things a little bit. And I think for us, we're obviously in Gwinnett, so this affects a higher percentage of our clients than maybe some others because we are in a area where this has a direct effect on people. We work with a lot of teachers, a lot of couples that this affects. So a lot of good news for the individuals that are going to get an increase, and hopefully take a little bit of pressure off of their other assets. So a lot of people are in for an increase. One thing that really jumped out at me is the survivorship planning, and how that's going to affect the widow or widower's income in the future, and the average increase of almost $1,200 a month is substantial.
It is
So
substantial. Yeah.
that's
Yeah.
hopefully going to be a good thing.
Yeah. And
But
I
I
have
know
to mention
there's
too. Oh, go ahead. Go ahead.
no, go ahead, Heather, go ahead.
No, I was going to say, we mentioned that, it's kind of like in Georgia, it's a bi-county thing, especially for teachers. But you think about how transient America is these days. So, we'll see more people than we really anticipate, because if they came from a state like Ohio or California or Texas, these states that are completely non-covered in these positions, and they move here, those are the situations where, with the transient nature, people moving all over the place, you could have a complicated situation where you worked over here as a teacher in Ohio or Texas or under CalSTRS, so they don't pay in. So there's a lot of different nuances where it can affect you in different states as well. So I'll just put that out there.
Especially in
Heather,
Georgia, because I don't.
sorry, Abby.
Go ahead, April.
I was going to say there's one more really good question here that I wanted to kind of slide in before we wrap up. Didn't mean to interrupt you there, Abby. The question is, do you feel like this lays the groundwork for additional changes to Social Security?
Well, I hope not. And from the standpoint of the way it's going, because this is obviously pulling money out, which it's good for the people that it increases benefits, not good for everybody else, right? Because, we are taking money out, whereas we really need to figure out how to shore up the system. Now, again, insolvency is that terrible word, and a lot of people don't understand it. They just think, oh, it's not going to be there. It will be there, because as long as we have workers paying into the system, we're going to have benefits. But I think that, these, people, these lawmakers and these proposals, it's like, okay, you don't want to be unpopular, but the reality is we've got to do something. So do I think there are going to be changes? Yes. Do I know when? I don't know. I mean, they waited literally within 4 or 5 years to insolvency, and even less than that, the last time we were on the brink, during the Reagan administration. So, yes, there's going to be change. Whether it happens in the next 4 years during this tenured president or future, I don't know. But we're now, we're there. We're within. If you're looking at, spousal survivor and retirement benefits, it's 2033 is the year that it starts to be reduced. 2034 is for the combined trust funds with disability, which gives it a little bit more of a boost. So they got to do something. Whether or not this is going to be an issue that takes center stage with everything else right now, I don't know. I'm curious to see what happens in the next few months, to see if it gets any legs in a positive direction in terms of getting money into the system. But I don't know. Remains to be seen.
Thank you.
Yeah, we're all eagerly awaiting something to happen, somebody to have a bright idea or I don't know, a fix of some kind. But I fear, like most people, that it's going to get kicked. The can is going to continue to get kicked down the road because nobody wants to be the one that makes the changes that are, that unpopular. But we will continue to really monitor that. That's why we have you as one of our strategic partners. You're a wonderful resource on all of this, especially with just massive changes. I feel like the past 5 years have been nothing but changes in the retirement community.
Everything in retirement, retirement related
It's just
in general. Yes.
Yeah, it's just been a whirlwind, and it has kept us busy. So that's been interesting to deal with. So your expertise and help has been invaluable for many clients that we've worked with you on weaving the web of Social Security and how confusing it can be. So we will be working with our clients on this. And if you have any questions, how this affects you personally, reach out to either myself or April, and we'll be able to hopefully walk you through this first year that it applies, and figure out how it affects your overall income plan. So we do a lot of Roth conversion planning with our clients, and more income means that might need to be tweaked a little bit. So we'll look at all angles, so tax planning, income planning, in your investments, how it really has that domino effect. So we will be here for you and hopefully be a good resource for figuring out how this affects each individual circumstance. So thank you, Heather, for your time. I know you're very busy. You're very in demand, so we appreciate you spending this hour with us. I think really that's it. April, you want to take us away?
No, just one more question rolled in about how Social Security will get in touch with them so they know it's legit. Great question, because in this day and age, we see so much when it comes to, different types of fraud. So fantastic question. I'm so glad that you asked that. And, we don't know yet, I think, and, probably Heather, I think that's probably what you would echo as well. We don't know yet, but a very good practice is, anytime that you receive anything that you have any hesitation, any question at all, whether or not it is legitimate, reach out to some of your trusted resources like us. If it's something that's in an email, don't click anything. Make sure that you're doing those extra steps of diligence. Certainly, as additional information becomes available, we will, as always, make our best effort to get that information to you in a timely fashion and keep you updated and ahead of the curve. But great question. And to echo what Abby said, Heather, thank you so much for your time. We really appreciate you. And for those of you who are with us here or may watch the recording thereafter, please never hesitate to reach out to us for help, and we're happy to do it. Thank you so much.
Thank you.
Night, everybody. Stay warm.
Yeah, thank you. You too.
Thanks, Heather.